welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Madan Sabnavis, Chief Economist at Care Ratings, joining in. Madan, welcome to the show. And as always, a pleasure to speak to you and get insights from you. Madan, overall, if you go to see in terms of a lot of indicators right now, early data is indicating that we've crossed the pre-pandemic levels. However, the sequential momentum is something which is slowing down as well. What's the sense that you pick up?
I think when we're looking at any of the macroeconomic data, I think we should remember that almost every indicator is going to look better. But that's because of the base effect. I think that's what we economists keep saying, that because things were terribly bad last year, this year everything is going to look very, very good. So even in case we're talking of overall growth being in the region of, say, 10 or 11%, that's what the government is saying. We at Care Ratings think it'll be 9 to 9.2%. But even if I take the upper level of around 11%, we would probably be 1 or 2% higher than that of 1920. So that said, I think the positive thing to take from the data is that things are moving only in the upward direction. So that's a big positive, because there were a lot of fears about there possibly being a third wave and we could be pushed back further. Now with the vaccination drive being fairly successful, and it's encompassing a larger part of India's geography. Also the fact that we have had two reverses in the form of two kinds of lockdowns. I think everybody has learned, both the government as well as enterprise, as to how to deal with another pandemic or another kind of lockdown. So I think overall we're definitely better positioned. But I would only be careful while interpreting a lot of this data, because I think this particular season, that is from September, October, November onwards, I think that will be very critical, because the overall demand story has to materialize if things have to be fulfilled this year.
Right, but overall, Madan, on a sequential basis, it seems that the momentum is slowing down because both urban and rural unemployment has inched up in the month of August. I think the urban unemployment stood at around 9.8% versus rural unemployment stood at around 7.6%. Do you think the best of rural growth also now seems to be behind us with these kind of numbers?
Yeah, in terms of employment, I think it was always a problem even before the pandemic. And we always felt that even though we had growth, we did not have commensurate growth in employment. Jobs were not being created. And that's one of the reasons as to why I think demand had stagnated and had pushed back investment to a very large extent. But today, when you're looking at the rural economy, especially if you look at the agricultural sector, while the first advance estimates does sound promising, we do believe that things are going to be good. But the whole question is that will people be in a position to spend or not? Okay, because this time the pandemic has infiltrated the rural areas. People have spent more on health. A lot of people have moved out from their jobs in the cities and gone to the villages. I think there has been a reverse migration again. People have come back when it's large industry, but when we are talking to the SMEs, we don't get the same sense. So therefore, definitely there has been a case of job losses in the SMEs in the urban areas. And even if I look at the rural areas, I think the people have not really gotten a commensurate employment. So therefore, there will be a case of saying that employment has received a pushback, and that is something which could be coming in the way of the future progress of the economy, especially in this critical second half.
Right. So overall, Madan, between growth and inflation, where do you think will the government's energies lie from here on?
Actually, there's a kind of a paradox here, because since last year, I think the government and the Reserve Bank have said that growth is more important and inflation can actually take a backseat. But today we have realized that inflation, which was above 6% for the whole of last year, and even in the current year, it's been more than 6%, though I think the last couple of months it came down to less than 6%, and probably we may get a number in the region of 4 to 5% in the next 2 months. But the fact remains that inflation, especially core inflation, is very high even today. But the paradox really comes that we still haven't decided whether growth is on path. If we really believe that growth is taken off, like what the government says, 11% growth, if growth is really taking off, then I think it's time to actually turn to inflation. Now, today we have always covered up by saying that inflation is transient, which I don't think inflation at over 6% for 18 months can be considered to be transient, especially when you look at some of the components of inflation, things like fuel inflation, where I think the government has a large role to play in terms of the taxes. And the other segments of inflation, that is, if I keep food inflation out, we look at the other segments which are driven by the MRP. I call it the MRP inflation, because that's maximum retail price. The moment the price has been increased, at any point of time, it will never get reversed, it will never go down. For food prices, we know that inflation can go up, it can come down tomorrow. Tomatoes go to 100 rupees a kilo, we'll have very nasty inflation. It comes down to 10 rupees a kilo, we have low inflation, and we can rejoice over it. But today, if you look at the non-food parts, we have seen that things like health, education, consumer products, I think the inflation has gone up because of MRP. Especially if you look at healthcare, it's actually been very, very stark, from 15 to 20% across the board. We've seen the prices of medicines which have gone up. Now, those prices won't come down ever. So therefore, I feel that inflation is a major threat today. And notwithstanding the fact that numerically we may look more comfortable in the next 2 months, and probably the MPC may say that from 6% now we've come down to 4.5%, so therefore everything is good. But the fact remains that inflation hits us actually cumulatively. And if I look at 6% inflation last year, maybe 4.5, 5, whatever number we finally get this year, it is actually pushing us back significantly. So I think there's need for us to actually take inflation more seriously.
Right. So overall, if you see the latest print that did come out with regards to where the CPI numbers go, it moderated to around 5.3%. However, is there a possibility that we could see some more pressure with regards to where the core CPI inflation goes in the coming months, taking into consideration the pass-through of higher raw material prices as well as costs? And secondly, if we are seeing a decline in CPI inflation, do you think that will provide some respite to the RBI to continue with their accommodative stance as well in the near future?
Yeah, actually, Hiral, what happens is that when inflation is high, I think the view which the MPC has taken is that, look, it's because of food inflation. So even though they're supposed to target headline inflation, but they say, look, one particular component, food inflation, is high, over which none of us have any control. And today, when we're looking at a situation where food inflation is low, but core inflation is high, then you suddenly say that, look, your headline inflation is coming down and therefore inflation is under control. So I don't think the RBI or the MPC is going to look at this with any kind of ambivalence. They're going to very clearly say that, look, inflation is coming down, it's trending downwards. And besides, they're looking at a 4% with a 2% margin, and we are very well within that 4 to 5%. So I think the RBI's interpretation is going to be that inflation is very much under control. Even though if you look at the underlying factors of the non-food part, is quite serious today. Because we're seeing even oil prices likely to go beyond 90. That's what I think Goldman Sachs or somebody has said. So we're actually talking of a situation where energy inflation is going to be very high. And that could also permeate through the other costs and could provide an upward thrust even for food products at a later point of time. But today, I think the huge comfort we're getting is that because of food inflation coming down, that is really helping to moderate the overall index, I mean the headline inflation number. And that's what's giving solace to the regulators.
Right. With this, if you see the credit growth as well, the bank credit growth seems to see a slow rebound. It was up around 6.7% on a year-on-year basis in the month of August, however, largely flat on a month-on-month basis. What do you make of this number?
See, if I look at the credit growth numbers, I think I would prefer to look at the growth over March rather than annual, because when you look at year-on-year growth, a large part of that growth would also be in the last financial year, in the actual incremental growth. If I look at it in terms of what's been the growth between September, last date which came out, 10th or whatever it is, over March, we are still in a negative territory. So there's been a decline in growth in credit. And in talking to bankers, the sense we get is that it's both a case of willingness to lend as well as the overall demand, which is there for funds from corporate India, is definitely lower. Because on one hand, we have seen that corporates have been deleveraging, they've been more careful when it comes to going in for fresh investment. So that is something which is also getting reflected in the corporate bond market, where the issuances are much lower than last year. So admittedly, last year we did have the benefit of the RBI policy of TLTROs, which added a lot of liquidity to the system. But as of today, if you see, the demand for new projects is down. And second, if you're talking of banks, they're also more cherry picking their customers. So therefore, they're preferring to lend to the retail side rather than to the corporate side. And even within the corporate sector, I think it's more for the larger corporates who have better ratings. And I think a part of this increase, which you're talking of even year on year, we should remember, it's actually coming from the SME segment, where you have the guarantee which is being provided by the government. So if you remove that guarantee, I'm quite sure these numbers will not look as good as what they're looking right now.
Right. And overall, with the recent numbers that the government came out with for the second half FY22 borrowing, it's largely on target. What do you make of these numbers? Because they've pegged the gross GSEC borrowing at around 5.03 trillion, which is almost around 41.7% of the total. And the net borrowings in the second half of FY22 would stand at around 3.78 trillion. Do you think there is a possibility that the government could overshoot, or do you think they will be largely on target?
I think we'll have an anomaly in the sense that the fiscal deficit will be higher, but the borrowing program is not going to get affected. So let me try and explain this, because today we're looking at the numbers of 12 lakh crores, which they're supposed to borrow for this year. I think there's been one statement made in that press release saying that it also includes the borrowing which is being done for the GST state compensation. So that's around 75,000 crores or so, because I think, or rather they did 75 earlier and have to do another 80 or so this year. It was a total of 1,59,000 crores, which was to be borrowed outside the budget. Now they've said a part of it, half of it, I think, has probably already been done. Now they're saying that even this balance of GST compensation is going to be a part of this 5.03 lakh crores. And that comes as a surprise, which actually says that if I remove the GST compensation part, the gross market borrowing of the government is going to be lower. Now, is this actually possible? Because if you look at the revenue and expenditure of the government, a couple of things come out. One is that even if you assume that all the tax revenue, non-tax revenue, I mean, telecom, we're giving that benefit, there would definitely be a loss of revenue. But even in case your overall revenue works out, there's this huge question mark over disinvestment. 6 months to a year, we haven't seen anything much happening on disinvestment. Can we actually get 1.75 lakh crores? So I think a revenue shortfall on the whole is definitely going to happen. Even 50,000 crores of revenue shortfall, I think is the most conservative number which we could look at. But even that would mean that you will have to have a higher fiscal deficit. Second, if you look in terms of expenditure, Hiral, the important thing is that if you look at the last time the program which was announced by the finance minister, there were a number of expenditures, the fertilizer subsidy, the free food, and it was said very clearly outside the budget. It's not a part of the budget. So there itself, we have seen that there is something like 1 to 1.5 lakh crores of additional expenditure, which the government said was going to be spent. So if you have a situation today of saying an additional expenditure of 1.5 lakh crores, and even if all the revenues are met, it obviously means that the fiscal deficit is not going to be at 6.8%. It will have to be higher. Now, how can we reconcile the two? I have a feeling that what the government will do is that you can always use treasury bills, finally, roll over your treasury bills to make sure that you're financing this higher fiscal deficit. You could be taking more from the small savings fund, NSSF. And third, you can draw down on your cash balances. So the way we're looking at it, we haven't yet done the exact calculation, but there could be a slippage of at least 1% in terms of fiscal deficit. Instead of 6.8, we're looking at 7.8%. But this may not necessarily translate into higher market borrowings. So I think that's something which the government wants to keep sacrosanct by saying that we're not going to crowd out in any way by borrowing more in the market. And actually, the current numbers show that you may be borrowing less. Because if I take out the GST compensation, if we are actually, the government's gross borrowing program will probably be in the region of 11.25 or 11.3 lakh.
Right. So in case of no incremental borrowing, how good will it be in terms of where yields are concerned, and how do you see the bond yields moving then?
I think there's always been a difference of thought between the markets and the RBI. So the RBI has been infusing, I would say, too much of liquidity in the system. You don't need to have 7 to 8 lakh crores of surplus liquidity. You don't need to have GSAPs. You don't need to have open market operations when there's too much of funds. In fact, here, one thing which I've never understood is that why is it that banks who are holding on to government securities, which give them even a yield of 6%, should actually sell the security back to the RBI and invest it in 3.35% reverse repo? It doesn't make sense to me. I don't know if there are any bankers who may have asked this question. They should be in a better position to answer as to why is we having this kind of an anomaly. So anyway, the long and short of it is when you have so much of liquidity in the system, you're ensuring that the GSEC yields are kept down. But if you look at where the market is reacting, I think the market has always been suspicious of the GSEC yields because they felt that government could be overshooting the borrowing program. They felt that inflation is very high and therefore interest rates are going to go up. So I think there's a kind of a pull pressure coming from the market. So if you actually go back to the 10-year GSEC last week, there was no reason why it should have suddenly jumped from 6.13 to 6.18 by Friday, because there was expectation that this second half borrowing program is coming out. Once it came out, it didn't seem to be convinced that the yield should come down. So actually, I felt on Monday morning that the yield should actually come down. But it actually went up to 6.21, and I think it's still stuck at around 6.20, 6.21. So I think this kind of a constant tussle will be there between the liquidity measures of the central bank and what the market really feels. And I think the best case scenario is that we are talking of the 10-year being between 610, 615. Though actually in the month of March, if you asked me, I would have said that 6.75 would be a fair valuation of a 10-year GSEC. But I think because of the surplus liquidity and what's being done, Operation Twist, all kind of measures which have been taken by the central bank, they're ensuring that the yields are kept low.
Right. So overall, another thing that is actually having an impact with regards to where the bond markets go is with what's happening in the US with regards to their tapering, and secondly, the inclusion of the Indian bonds in the global indices. Overall, how would you look at this picture for the bond market?
Let's get the first one. If you're looking at the tapering which is going to take place, I think as and when it takes place, there will definitely be an impact on India in terms of whatever allocations are being made to emerging markets, in which case we will also get affected in terms of what are going to be the flows, both into the equity market as well as the debt market. Okay, so especially if you're looking at debt market in particular, because if I'm talking of GSEC yields, I'll have to see what really happens to the debt segment. We could be expecting that there would be a lower quantum of flows which would be coming to India in the debt segment. So that is because the yields in the US will be tending to move upwards. So therefore, there would be a kind of a disadvantage which we will be having. Now, in terms of inclusion of Indian bonds in the global indices, it needs to first play out. Second, I don't know how the foreign investors, the foreign markets will be looking at an Indian market which seems to be highly regulated. Because today, if I'm looking at the government bonds, I don't think we're getting a fair market valuation. Okay, because it is being driven downwards, which helps the government a lot. They're all domestic debt, they're all domestic players, so there's not too much of an issue out here. But the fact is, I think, will the foreign investors be convinced that this is actually a market-oriented bond market, and therefore let's put our money here? Because today, logically, I think, like all of us talk on these shows, we keep looking at the fundamentals and saying how the GSEC yields should move, how the prices should move. But ultimately, they don't move down in that direction, because there is a certain regulatory push which is coming in, which ensures that the bond yields are working within a certain price bracket. So I think, therefore, I think it'll be interesting to see as to how actually this works out. Because today also we have seen that there is a lot of interest which has been shown by foreign investors when it comes to government securities, but definitely the same interest doesn't go to private bonds. If you look at the amount of allocations which are there and what are the limits which have been used, I think it's around not more than 30% or 35% has been utilized, which means that corporate bonds don't seem to be interesting for the foreign investors. In terms of GSECs, yes, to the extent that they are allowed to invest, I think there is investment going on. But the whole idea of getting caught up in these global bond indices is that where you actually have people arbitraging across markets. You see Indian markets, you use that as a kind of a prop, and then accordingly you take decisions on other kind of markets. You can do it provided this market is being driven by the market forces rather than by any kind of this liquidity management programs of the central government.
Right. So over the next 12 to 18 months, what's the kind of range we should be looking at for the bond markets?
See, if the RBI is going to continue with this, I think 6.10, 6.15 will probably continue. But let's assume that we have a little more sanity and the surplus liquidity of 7 to 8 lakh crores actually becomes more reasonable. Actually, we should not be having this kind of surplus. To my mind, not more than 1.5 to 2 lakh crores should be the surplus in the system, because quite evidently banks are not doing their normal job of lending. And that's why we have this kind of surplus. I would tend to think that something like 6.4, 6.5 should be the kind of range when you're looking at an economy which is growing, inflation which is increasing, and also a government which is proactive in terms of spending. So we would be continuing to have probably a large borrowing program, maybe not in the region of 12 lakh crores, but something in a double-digit range for certain.
All right. Thanks a lot, Madan, so much for getting us these information and these insights. Always a pleasure to speak to you. Thank you. Stay safe and speak to you soon again.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.